Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, our guest is Alex Perny of Advanta IRA, and he joins us today to talk about self-directed retirement plans. A lot of you might be somewhat familiar with this concept of buying real estate or other alternative asset classes in your retirement accounts. Typically, if you have an IRA or a Roth IRA at a major brokerage firm like Merrill Lynch or Fidelity or Vanguard or Charles Schwab, you can buy any publicly traded security really that you want, stocks and bonds that are traded in the public markets. But they're not able to support you if you want to go buy a rental property down the street from your house. That's possible, but you have to do it through a different vendor that can help you direct the trust in a different way. And that's what Advanta IRA does, and that's what Alex joins us to talk through today. This is a really interesting conversation because he walks us through the do's and don'ts. He walks through when it is and isn't a good fit for you. He answers a lot of questions I had surrounding whether you can obtain a mortgage and borrow against IRA-held real estate. He answers what to do about mandatory distributions when you own real estate in an IRA. Just a lot of odds and ends that were informative and really made for an enjoyable conversation. And I hope you like it too. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hello, Alex. Thanks for being on the show. I am really looking forward to talking to you about self-directed retirement accounts today.
Yeah, absolutely. It's one of those things where I'm kind of a unique individual in this space in that, just like no one is actually born in Florida, they're all transplants. Not only am I a native Floridian, but also I've had my whole career basically stuck into alternative assets, self-directed IRAs, being a financial professional and never having once had to deal in the publicly traded stock sector is really a bit of an oddity. But, I'm excited to talk to you about it today. There's a lot of really cool stuff that people just aren't, inherently aware of on the, massive amount of options you have with retirement plans. There's kind of a narrow focus that people tend to have of them, and it's really just not the case.
So I definitely want to get into why this is an option, how this exists, what the structure is, how you get into it, what are the ins and outs, what do people need to know about. But I'm curious how you found yourself in this space in the first place. Walk us through how you got to where you are today professionally.
Sure, absolutely. So, coming into college, I was, going into, finance in college at a really great time to be in banking, which was 06, 07. I graduated in 11, and, there was still plenty of blood on the streets in the financial sector, when I graduated. So, not to really make light of it, but I literally had to get a job in the mailroom of our firm here to just be like, hey, look, I don't want to be a valet at a children's hospital anymore, and just kind of got my foot in the door. And we were a really small outfit at the time. I was about 9. I think I was the 8th hire at Advanta IRA, and we had about $200 million of assets under administration, and now here today we've grown into what we are today with about $2.7 billion AUM, about 38 employees. About 10,000 individual clients, strictly just focused on the alternative space. So, I got the bug for it. I like real estate is something I'm really passionate about, and basically anything that's not beholden to the stock market. I like to think a little bit outside the box, and that's what this has afforded me. So it's been a really interesting ride to see where this has gone and see all the interesting stuff that people have done with these types of accounts while not touching any traditional securities.
So in an organization of 9 people, they had one full-time spot devoted to handling the mail? Am I understanding that right?
That's kind of funny. So, yes. So, at that point, we still had very few people, but so much what people don't realize in the background of a lot of finances, there's a ton of mail. So in its focus of what we do, handling a lot of real estate, a lot of other stuff. I mean, even though we were a small company, we probably administered let's say 2,000 individual pieces of real estate for clients, which each one of those is going to have a tax bill. Each one's going to have its own insurance policy, rent checks every month, code violations, all this kind of stuff. So while, at that point we were very small, there was definitely a need for it. But of course, I had to wear different hats. So it was sorting the mail, sorting checks, coding checks, accounting, transaction posting, all the back end granular stuff that is not the most glamorous of positions was what I fell into.
So where did you go from there? What are you doing today, and what was the career path like at Advanta IRA?
Yeah, so I did that for a little while, and so the trajectory of Advanta, we started in 2003. So next month will be 20 years that we've been doing what we did. And we started out as a franchise of a larger company called Intrust. You're still in business out in California that do alternative assets in this. They stopped their franchising program in 11, and we got full control over our company at that point. So we started developing our workflow systems to kind of make us what we are today. So I got the foot right in when we were doing all the transitions, which involved re-registering every piece of real estate we had to our new company, like administration, a lot of stuff like that. So proved that I was detail oriented enough to handle client capital and transactions. And then another hire came in right after that, a good friend of mine, Paul. And we started doing transactions that having dedicated service management to our clients, and kind of focusing on the customer service aspect of what we did. So, I got assigned about 3,000 individual clients and was maintaining all investments and everything. So that was a fun point in my career, buying real estate, investing into limited partnerships, private stock. I looked at it, and in that maybe 4-year span where I was directly involved with client account management, I think I handled over $400 million worth of client invested capital over about, I think it was something like 1,800 individual transactions that I had some part in with our clients doing. So that was the kind of career path up to there. And then it kind of opened up that we were trying to expand our business more. We had gotten some traction with what we were doing. And then I moved into sales and development. And that's what I've been doing for about the past 6 years almost, strictly focusing on new business, referral management, and education. So that's why I run our podcast, which we're very happy to have you on as well. And, getting out there and spreading the good word about the options that people have. And it's been fun. It's been 12 years in May. So when I'll cross that point in my career. So it's been a long, strange trip. It's been fun.
Well, good for you. It must be fulfilling. It must be a good gig for having been there for so long. Do you have a stake in the partnership or the equity at all at this point?
Not an equitable owner, but they treat us very well. It's a company that I enjoy working for. You can still run into the owner every once in a while. We still have the corporate Christmas party at his house. Everyone's very accessible, and it's a very, very nice place to hang my hat. And the other nice thing is that while certainly could I make more money being a broker dealer, getting my Series 7 and going out and getting into the securities world, I also don't need to have someone do a wellness check on me when the Fed starts raising interest rates and everything's tanking. So it's I like the stability that this type of market offers, which I think a lot of people for retirement, in general, bleeds over into the employee experience are kind of looking for as well. You don't want high volatility in your retirement. Maybe your personal assets, you're willing to tolerate more risk. But again, that's kind of my view on it and seemed to work out so far.
So walk us through what exactly Advanta IRA does and why we're having this discussion in the first place.
Yeah, absolutely. So, so it's a little bit of a history lesson. I'm a big history buff. That's kind of my thing. I love history, and you're going to get a little bit of a history lesson today. So to understand what we do, we have to go back to the Carter administration. So back in 1974, there's a chunk of legislation that was passed called ERISA, which was the Employment Retirement Income Securities Act of 1974. And what that did is it aimed to give some franchise to the individual taxpayers that weren't covered by a big collective bargaining agreement, that didn't have large pension plans. So it created 401ks and IRAs to give retirement plan abilities to small business owners, and by me, big businesses as well, but also allow tax advantage savings for individual participants, such as IRAs. Everyone's kind of familiar with what an IRA is. Now, what they didn't do at that time was give us an extremely detailed list of what you can and can't invest in with those things. They said basically two things, or three. You can't invest in a collectible, you can't buy a life insurance policy, and you can't buy or sell anything to a disqualified individual. So think your immediate nuclear family. Past that, they said it's up to the banks and financial institutions to say what they will and won't allow you to invest in. And that's how we got IRAs and 401ks. So with that said, big banks kind of said, hey, we can, broker dealers, hey, we can sell people stocks in these things. Hey, we can put mutual funds in these things. And that's just kind of the nature of the economy of scale of that. But there were some companies that were born out of that by people saying, hey, I can buy a piece of real estate in my IRA. I can invest in private bank stock. I can do all this other stuff that I want to. But by virtue of the fact that firms like us don't sell investments, the growth factor of that type of business is inherently going to be slower. So, you've been able to do this for, the better part of 50 years, but it's just the fact that people haven't heard about it. They don't know it. They think it's something unique or new. It really isn't. Like I said, you have to go back to the Carter administration to see when this stuff got its start. So, come into what we're at, and that's all we focus on. We don't do any of the broker dealer stuff. We strictly do alternative assets. So if it's not a publicly traded security, bond, ETF, we will hold that within a retirement plan for a client. And the biggest thing that people don't understand is, if you go to a broker dealer, let's say at Schwab or Fidelity, and you talk to someone in their back office and say, hey, you know what? I want to buy a piece of real estate with my IRA. Or, hey, someone is putting together a private offering for a startup company. I want to hold some of that stock in my IRA. No fault to them, but normally they're kind of triggered to say, oh, well, if you want to do that, you can't do that in an IRA. You have to take a distribution, pay taxes and penalties. Well, you can, you just have to have a company willing to hold it. And that's the service that we do. Strictly alternatives. We don't sell any investments. We're record keepers and custodians of actual alternative assets. And I think I mentioned this when you were on my podcast, is that I hate the word alternative in the context of real estate, because heck, the Romans were acquiring real estate. Stock markets didn't get invented until the 1600s. It's easy to see how these kind of tangible investments really, they don't make sense for everyone, but they can be a very viable option for people looking for real true diversity out of a securities market.
Sure. We've talked about this evolution, beginning with ERISA a little bit on the podcast, and this is really the core piece of legislation that governs 401k plans. And if you're a small business prior to 1974 and you want to offer some kind of retirement benefit for your employees, you don't really have a whole lot of options, right? It's offer this big, fat, heavy, bona fide pension plan that comes with all sorts of strings and long-term liabilities, or find some other benefit to offer. And so if Section 401k created in ERISA was really a big deal. And having individual retirement accounts that aren't even attached to any kind of employment, this just opened the door on a lot of stuff. And I came from Schwab. That's where I started my career. And from their perspective, they're a big custodian. They have Section 408 trusts, which are IRAs, right? But just like a 401k plan, an IRA is simply a type of account with an agreement of what you can and can't put in it at your respective broker dealer. Outside of those few limitations that you listed, collectibles and a few others, right? It really doesn't matter what's inside the account. It's just what your custodian is willing to monitor and maintain and handle on your behalf. And big broker dealers that work in the publicly traded securities world, yeah, they might offer you a few very limited private investment options that go through their special platform. But by and large, if you want to buy a rental property down the street, that's not going to go in your IRA at Schwab or somewhere else. And it's something I think most people don't fully appreciate.
Yeah, and that's a big part of what we do is, again, educating people to to appreciate just how beneficial that can be. And again, you are on the advisor side. I always have to say, I can't advise anyone on what they should or shouldn't do. Strictly, we're not advisors here at Advanta. So whether or not, this type of asset makes sense for you, again, that's for you to bear and figure out. But the ability for you to have that amount of diversity is a really powerful tool. So if you're looking for something that's really going to offer you true diversity, because you might be invested in securities that are in different markets. You might be invested in energy. Then you might be invested in, let's say, Coca-Cola. You can get diverse markets, but at the same time, let's say, the Fed decides to start raising rates, that whole stock market can be affected. Whereas with investing in alternatives, you have the benefits to look at a lot of different pathways. You can invest for cash flow. You can invest for appreciation. You can invest like price point agnostic, meaning that it doesn't matter the price point of something. If you're investing for long-term cash flow, your cash flow is not going to be determined by the underlying value of what you bought. So dividend stocks, your dividends based on share price, whereas a piece of rental real estate, you might have paid X for it, but if it cash flows at a certain rate and you're looking at that as a long-term hold, those types of options are really awesome for clients. And again, not all clients, but to have that ability, I think is a powerful tool for any investor, just to realize, hey, we're not just beholden to a certain subset of X. We can really have, the entire alphabet at our fingertips. Again, can't buy collectible life insurance policy, things like that. And you can't self-deal. So again, that's one of the things I really like and appreciate about this whole ecosystem that we have, is just that amount of real diversity that you can get.
So walk us through this. Let's say that somebody has, $200,000 in qualified money, meaning it's already inside of an IRA. They want to put it in real estate or some other kind of limited partnership, venture capital, whatever, some kind of alternative investment. Where do you start? How does all this work?
And the answer to this is really kind of getting at the core focus of why companies like Schwab and Fidelity don't want to do it, because it's very hands-on. You can't just point and click something or run a big macro, or have a workflow built into your Bloomberg portal that will automatically rebalance and stuff. Buying these types of alternative assets requires some boots on the ground. So for real estate, for anyone that's not familiar with how to buy real estate, there's typically about three parties that are going to be involved, or four. There's the buyer, in this case, which would be the IRA. There's going to be, if you have an agent, so your buyer's agent, seller's agent, and title company or real estate attorney, depending on your state. So with that said, same person, and I'll flesh out the examples of kind of a more passive and a little bit more hands-on investor. So let's say a client wanted to buy a piece of real estate. They open an account here at Advanta, and then they've identified 123 Main Street's what they want to buy.
And that account is an IRA. They're opening an IRA at Advanta.
They're opening an IRA, and and the type of account is going to be completely dependent on what you currently have. So if you have a Roth, you're opening a Roth. If you have a traditional 401k, all the kind of stuff, it's still within an IRA. You're not taking stuff out. The funds never touch your bank account. It is no different functionally than going from Schwab to Fidelity. Again, face value, it's really that simple. So let's say you want to buy a piece of real estate directly. Rental property, fix and flip, doesn't matter. The process is really kind of the same. So you open the account, you've identified a property. You give us a call and say, hey, look, y'all, we want to buy a property at 123 Main Street. So we would then engage with everyone, make sure the contract's correctly written in the name of the IRA. We have to sign it as the custodian, review settlement statements, tax prorations, estoppels, assignments of rents and leases, all the kind of stuff that goes into it. And then ultimately at closing, we wire the funds to closing. The deed's recorded in the name of the IRA. So if you look at the deed, if you want to look at an example, look at Pinellas County and search Advanta IRA, and you'll see hundreds of properties locally to us that our clients own. So Advanta IRA, for benefit of IRA 123, would actually own the property. And then if it's rented out, you get to determine the renter, you get to qualify everything, and then rent checks every month are going to start rolling in, assuming that was your strategy. You could certainly go the route of a fix and flip. You could go, some type of development and have partners that come in and do it. It's the nice thing about this is that you're not constrained to one avenue. If you are familiar with real estate or there's some type of project you want to get involved in, there's typically a path forward for that. And again, one of the reasons that big banks don't offer this is that you have to have someone that can know all of that and how to actually do it correctly and efficiently. You can't have someone learning on the job and take 45 days to close a piece of real estate when it's a cash deal and you want to close in 15. Just doesn't work. So again, the individual direct ownership of real estate with an IRA, I teach a 3-hour CE course on that. It's stuff that can get very, very detail oriented. But a lot of people, especially to your point of the private equity side, things like limited partnerships, commercial real estate ventures, those are becoming increasingly popular. One, because real estate's expensive. Buying that 3-2, in most markets is going to cost you $350,000, $400,000 to do. And the amount of people that have that much money in an IRA is a lot smaller. But investing into things like real estate syndications, apartment buildings, private offerings like that, you can typically buy into those for like 25 grand, 50 grand a share, which is a lot larger of the population. So people would have their IRA subscribe to that offering, and then the quarterly preferred returns are returned back to the IRA. And the big key umbrella to all this is that none of this is touching your personal tax statement. Just like a dividend from Coca-Cola goes back into your IRA at Schwab, all of these revenue streams that are coming from these different projects go right back into your IRA. You're not paying any taxes on those until you get retirement, depending on the account's going to determine any taxation. But all of that is just gravy. It's all returns back to the IRA. And you have the benefit of an alternative asset within the IRA. No taxes, no penalties, doesn't hit your personal income tax statement. So again, the breadth of what you can do, and in the simple context of this, is a really cool feature.
So somebody wants to go down this road. They've got $350,000 in an IRA. They open an IRA with your firm, Advanta. Now they have the account structure up through an IRA for the benefit of themselves. They wire Advanta the $350,000, and Advanta handles that cash just like any other bank or brokerage firm would, I suspect, right? You have a big bank account and are keeping track of all your customer accounts, who has what, and all the prudent things that a custodian would do. Is that right?
Yeah, it's basic accounting principles for omnibus trust accounting. It all comes in, and we delineate everything down. Again, it's basically kind of par for the course for what any other custodian does. Asset allocation, cash allocation. Again, I literally just had to explain that to a client when I just got off the phone about wire instructions to have money sit in. He pulled Fidelity's wire instructions. It was like, oh, here's my account number. I'm like, that is not your account number. You need to go to your account statement to get that, because if you put that on there and we try to pull funds out of their master like omnibus trust account, they're gonna get a little leery. So it's again, that's a little bit far in the minutia of stuff, but again, it's always good for people to understand how exactly this works, especially if they're new to it. Is that you're not necessarily giving anything up. While this may be a quote alternative way of doing things, by large, again, this stuff's all been done the same since the 70s, and up until now. So, but the exception of the fact that we're not selling you investments, you're bringing us the investment. We're helping you structure that within the plan, and the fact that you're not doing publicly traded securities, everything else is basically the same. There's really not an inherent big difference on any of the back end or back office side of things.
So somebody let's continue our example then. Somebody wires in 350 grand. If they're buying a piece of real estate for 350 grand, then you're helping process the transaction and get to close and all that. And then if they rent out the property, then cash is coming in that gets deposited back into the IRA account. They can leave it there, do something else with it if they want, right? None of that is a taxable event because it's happening within that umbrella of their IRA account. What if they want to go buy a property for $1.1 million? Can you borrow against the purchase price? Can you obtain a mortgage to do this?
So you can, but I typically caution clients to, and again, I can't advise clients, but I can strongly word an email, if you will. You certainly can do that. It is allowable under IRS regulations to have the IRA acquire debt financing. But
and when they do that, the equity the down payment is coming from your IRA, and the underwriter is looking at your personal income and assets outside of the IRA to write that note. Is that right?
That is not correct, actually. No, it's good that you asked that, because it's a real interesting way to look at it. So IRAs, and this will get also into solo 401ks for small business owners, especially kind of for the clientele that you have, is just really interesting. So let's just kind of start again a little bit beginning. IRAs can buy real estate all day, twice on Sunday. If it's cash, easy enough. The IRA has the money, wires it, closes it on the deed. We're good. Now, real estate's many things to many people, but it's not cheap. Like we mentioned, the amount of properties that are, getting up into the $300,000, $400,000, $500,000, $600,000, $700,000 range is increasing by the day. So if your IRA is short to buy it cash, or maybe you don't want to buy it cash, maybe you'd like to deploy it into several different assets and debt finance, which is certainly a sound strategy for some people. What you're going to do is that the debt on that, so the IRA as its own entity, and IRAs are most analogous to trusts, is what people need to understand. So the IRA as its own separate bucket is what's going to be borrowing the money. So in that case, the debt has to be fully non-recourse. And if you're not familiar with non-recourse, if you've never dealt in commercial real estate, basically what that means is that the lender, in the event of default, cannot come after any additional IRA assets. They can't come after you personally. They have to be okay with being made whole by the underlying asset that secures it, so the piece of real estate. So, if you have a $300,000 mortgage on the property and they foreclose and it's only worth $250,000, they have to be okay with eating that $50,000 net loss of it. Again, I think you hold real estate long enough and it's always going to probably make you whole, but neither here nor there. So that's what you have to do. So that's to be non-recourse financing. Strictly, and there's IRS regulations against this. If you are real gluttons for punishment, you want to look up the Internal Revenue Code. It's Internal Revenue Code 4975, which deals with prohibited transactions in the IRS code. And it states, and the reasoning behind it having to be non-recourse is that you can't levy a personal guarantee to your IRA. You also can't pledge creditworthiness or other personal assets as collateral for a loan in a deal. So that kind of leads into why it has to be non-recourse. Now, with that said, most people are like, well, if the bank can't come after me personally, then why would they even do it? Well, again, to that point, there's a lot fewer institutions in the U.S. that will lend on like non-commercial real estate and non-recourse. If you're talking about apartment buildings, industrial real estate, almost all that debt is non-recourse. So the viewpoint of the institution typically looks at the ability of the property to service the debt, not the person to repay if everything blows up. So typically on these types of properties, banks are not going to lend on things that are like development, speculation, that are not at least moderately rent ready. And they have to be within a certain, threshold of what market rents are. And to that point, they typically are going to have significantly higher down payments. So, think of like 30% as your starting point, and I've seen them go up to 50% loan to value for what they require. So again, that's kind of the aspect of borrowing money. And it gets better from there because the IRS says, well, wait, if you're debt financing within an IRA account, you're kind of, gaming the system a little bit. You're artificially inflating a tax shelter. If you could go out and borrow money to your heart's content, you could take a, $100,000 IRA, borrow $50 million, go out and buy all this stuff, and again, kind of game the system. I hesitate to use the word cheat because debt is everywhere. But again, that's their viewpoint. So what does the IRS do? They say, you know what, we're going to levy a tax to the IRA specifically that's going to kind of level the playing field. Easy way to think about this. Let's say you have $100,000 and you buy a $200,000 property with $100,000. That means your debt ratio is $50,000 or is 100,000. Sorry, is 50-50. In that year, you take your average underlying equity, you take your average underlying principal balance. Let's say it's interest only for easy math. And again, easy math be what it may. Let's say it's $2,000 a month in rent, right? At the end of the year, you have $24,000 a month in rent, and it's 50-50 leveraged. So you take the $12,000 that's attributable to basis right back into the IRA. Don't worry about it. The other part is going to be subjected to what's called unrelated debt finance income tax, which is fun because it's also a subset of another tax called UBIT, which we don't have to get into. But suffice it to say, the IRA has to file a tax return, and it might have to pay some taxes. But whereas if you bought it cash in the IRA, a tax shelter IRA, you don't have to file a tax return, so you don't need to worry about depreciation, amortization, any of that kind of stuff. But when you do finance, you get to use all that stuff and hopefully offset all of the income that would potentially be taxable. And also you can 1031 out on a sale to, again, help offset the what's called the UDFI liability in that case. And again, that's taxed at trust rate, so it can get a little bit garrulous. But in my opinion, if you're buying right and you're doing everything right, at the end of the day, even if you had to pay taxes, you get to put all of that back into a tax shelter. So it's not like it's coming to you personally and you pay taxes. At the end of the day, this is going back into an IRA. So then future gains, you can increase your basis in the next property and eventually really kind of supercharge it. I know it's a lot of information to take in on just the simple question of can you finance an IRA property? But again, it's something to definitely keep in mind is that financing IRA properties can be a little bit cumbersome. And I really recommend people, if you don't have enough money to buy real estate directly, look at other options. Bring in partners. Maybe have an LLC that's formed and you each plug in so you can buy the property cash. Lend someone the money. Be the debt holder. Hold a first position mortgage in your IRA. There's a lot of different options you can get to be real estate or real estate adjacent that don't involve buying the property directly.
Yeah, and all this taxation makes total sense too, right? If you have that $200,000 sitting in an IRA in a brokerage account, your brokerage firm is not going to go lend you another 800 grand off of the 200,000 of equity so you can go buy a total of $1 million of stocks, right?
Mhm.
The IRAs exist because of ERISA, because the government wants us to save for our own retirement. But they don't let you put, $1 into something and then lever it up to get, 10 to 1 leverage and go buy $10 worth of stuff. That falsely inflates the tax benefits that they're extending to people for saving for their retirement. So that all that makes sense. And if you do lever up, then the amount that's levered has to pay tax on income that comes in.
Yeah.
So look, let me ask you this. Then we talked about collectibles. We talked about life insurance. Those are relatively straightforward. You can buy outside of an IRA. You can go buy life insurance policies, and there are organizations that do this. If you have a permanent life insurance policy you don't need anymore, you can sell it to a company. You can't do that within your IRA. Collectibles cannot go into an IRA, so don't go buy Pokemon cards and baseball paraphernalia. What else falls under collectibles? Gold will sometimes fall under collectibles, doesn't it?
You can buy precious metals, but it has to meet a certain purity standard. So if you're buying, an easy way to look at that is that anything minted by a large governmental organization, you can buy those. They typically all meet the standards. So anything from the U.S., Mexico, Canada, China, Australia, Royal Mint, Great Britain. The only one that's an outlier is the South African Cougarand, which doesn't meet the purity standard. It still has 1 full ounce of gold in it, but they mix it down with some copper to make it a little bit more durable. So it's not like 0.9995 pure. So take that for what it's worth. Before we get too far into that, and I'll definitely address that question, you were talking about levering up retirement accounts. And again, to go back to ERISA, an interesting thing that was written into ERISA is that what are called qualifying retirement plans. So your 401ks, 403bs, QRPs in general that are qualified under Section 401 are exempted from that tax that I mentioned when acquiring real estate. So if you're a small business owner and you have a solo 401k, or if you have a larger ERISA qualifying plan, those types of plans can go out and debt leverage real estate to their heart's content, so long as the debt is being used to acquire new real estate and they don't have to pay a dime in additional taxes. So that's a really cool one. So I tell people, if you want to invest in something that has underlying debt service, if you're a small business owner, or let's say you have like a side hustle, you sell widgets on Amazon, you have something where you have something that's going to generate self-employment income, whether that's sole proprietorship, you have a small sub S, something that allows you to establish a solo 401k, you can roll over traditional IRA funds into that and old 401k funds, and you can go and swing for the fences and debt leverage stuff to your, until your eyes bleed. So that's a really cool part about the tax code. And, this stuff is, I like to tell people, like, this stuff is not cheating. It's written in there. It's just, you have to look at it, understand it, and figure out how it best applies to you. Because the government, for all their faults, and I'm sure we could talk about that as much as we want, they give you the playbook on how to pay them the least amount of money possible. Is it easy to understand? Absolutely not. That's why people like you and I exist, because we're a little bit more gluttons for punishment on it. So I just want to make sure that's clear, is that there are ways around it and ways to mitigate those taxes. And depending on the type of account, you might just be exempt from it. So,
now quickly, I would caution people out there listening to this. If you sold, some old Jordans last year on eBay and made $900 and you got a 1099 from eBay, don't do this with that income. It needs to be a legitimate business operation. You need to have at least a couple $1,000. Don't quote me on this threshold, but it has to be some kind of legitimate side hustle where you're reporting the self-employment income on your return. If it's a menial amount, or if it's you did it for 1 year and don't expect to continue, the IRS is probably going to win that challenge if you're ever
Yeah,
arguing
and I
on it.
tell people that the actual tax code is written something to the effect of um, sub, sub, substantive and realistic business activities. I think is kind of the words they use for it. The last thing you want to do is, again, that doesn't mean you have to have an LLC with 50 employees. It can be small stuff. It's I have a
Yeah.
friend that is has an Etsy shop. You
Hmm.
could certainly for something like that. I feel like you have a lot of stuff. You have a storefront that sells stuff. You shouldn't make a lot of money at it. Granted, it's little trinkets and stuff, but
Yeah.
it's not a one-off thing. It's a substantive, continuing business activity. So
Yep.
always get advice on that stuff. There are people out there in my industry that promote the fact that you think therefore you are, and anyone can have a solo 401k. Not naming any names, I highly disagree with that point. And I would be very interested to hear an IRS's agent opinion on that as well. So, just like anything in life, try to act in good faith. If you're confused on something, ask someone like Grant, ask someone like myself, and we can help guide you to that point.
Yep.
And then circle back around, full circle. I don't want to completely miss the point that you were asking about prohibited transactions. So again, there are certain things you can't invest in. And most of the time, people don't run afoul of like the collectibles and the life insurance stuff. That's really not where we see the issues. There's two other parts of like the prohibited transaction sphere that people run afoul of. So there's certain things you can't buy, and there's certain people you can't transact with. People you can't transact with are your direct lineal descendants and ascendants. So look at your family tree up and down. So mother, father, son, daughter, yourself, and your spouse, and as far up and down as you want to go. The IRS does not deem brothers, cousins, aunts, uncles, twice removed, whatever it is, you can directly transact with those people. And what do I mean by transact with? So let's say you're a real estate professional and you're hearing this and you're like, yo, I can put real estate in my IRA. Well, great. I'm going to get an appraisal on 123 Main Street and my IRA is going to buy it. Can't do it. You can't buy something that you personally own. You can't be on opposite sides of the closing table from yourself. Same thing goes with any of those other people or an entity owned or control, because the next question someone says that, well, I don't own it, a trust owns it, or I don't own it, the LLC owns it. My name's not on the title. Doesn't matter. The IRS, their flashlight shines through all that. Corporate veil structuring. I tell people just stay away from the direct family stuff. Granted, it might be easy, but cherry pick this stuff. Take a step back. This is really interesting stuff for a lot of people, but a lot of people kind of their eyes get big and like, I can do this. I'm like, take a breath. Let's look at this objectively.
It's got to be an arm's length transactions.
Yeah, but
Always.
the IRS doesn't consider siblings to be arm's length, or considers them to be arm's length. And what I would say to that is, one, if you want to deal with your family, that's your prerogative. But it can make for some really awkward Thanksgiving dinners if something goes bad. So do you really want to be dealing that close to home? And if you are, and I have some clients that deal directly with their siblings and cousins, the key point to understand in that is make sure you're dealing on a fair market value basis, because they could say you had an undue benefit from your personal relationship to them. If the property is worth 200 grand and you buy it for 50, well, you only got that because of your personal interaction. And that's kind of getting to that, again, it is a little bit in the weeds to say, well, my personal relation was kind of an abject like extension of credit. Again, what I would say to that is, make sure you deal outside your family for the most part. Entities owned or controlled by those people, because you go to tax court, unlike criminal court, you are under the obligation to prove your innocence, not the government's, and not the other way around. You go in guilty to tax court and you have to prove your innocence, unlike criminal court where you're under the burden and assumption of innocence. So take that for what it's worth. If I never have to go to tax court, I will retire a very happy man.
Does this apply to self-use too? Can you buy a vacation home in the mountains, rent it out for 48 weeks a year, and then use it for the other 4?
Great question. So this kind of gets into some of the little bit more of the details of it, and I love details. People should love details more. But so when it comes to buying a piece of IRA property, let's look at it from the rental property perspective, and we'll go through some of kind of the regulations that are involved in it. So if your IRA buys a property, again, think about it kind of like a trust. The IRA owns it directly. Now, the further regulations say so you can't get any direct personal benefit. So you can't live in it, can't stay in it. You can't do any of the work on it. And what I would say to that is that, yes, I know it kind of stinks that, if something needs to be done, do I have to go hire a contractor to do everything? Well, not necessarily. You can kind of act as or do you have to get a property manager? No, you can kind of act as the general contractor of property managers to where tenant calls you and says, hey, this is busted. Okay, cool. I'll have someone go out and fix it. You don't want to run afoul of the IRS for something really small. Granted, do I think every single one of my clients follows this? And, if a lock needs to be changed, they don't go and do it themselves? No. Can you walk through a property to make sure that the water heater was actually replaced and the plumber didn't fleece you for $2,500? Absolutely. But the line in the sand is that swinging a hammer, getting a paintbrush, technically could be in violation of IRS rules if your IRA owns it. And further to your point about vacation rentals, yeah, you can't go and stay in it. The rules on that is that you can't utilize it. Treat it like it's on the other side of the country from where you are, even if it's directly across the street. One of the few times that I ever saw someone really run afoul of the IRS was that they were basically claiming all of the expenses and write-offs and personally living in the property from an IRA-owned property. Over the 12 years I've been doing this, and what I'll say is that
they're writing off all the expenses on their own Schedule E in a property that's owned by their IRA.
Yep, that they also lived in.
Nice. That's the trifecta right there.
Yeah, they. I don't think the IRS had much of a sense of humor. It's again, you just need to be careful with that stuff. And again, it's people have a really big problem with that. And what I say to that is that does it kind of sting a little bit? Sure. I'm not going to sit here and tell you that. Oh, well, don't worry. Yeah, I mean, I'm relatively handy. I'm not going to replumb a house, but if I need a new water faucet, I'm going to go in there. I'm not going to pay a plumber to do it. But look at it a little bit more objectively. Back up, get up to a high level. Look at all the other benefits you're getting. You're getting, true diversity in retirement plan. You're getting all these great tax benefits from these assets. If you have to give up a little bit and say, hey, look, I have to, have someone do this. Okay. That's the give and take in this whole thing. And also to that point, IRAs, since it's the titled owner, the IRA has to pay for any and all expenses. So you need to, when buying properties, make sure that you have enough in cash reserves in the IRA to pay for those expenses. You couldn't personally float that. So, property taxes, IRA has to pay those property taxes. Insurance, the property has to be properly insured. It's got to pay those expenses. So, real estate is one of those unique assets that has a continuing cost basis you have to look at. It's not just like a stock where, okay, great, it went up, it went down, I sold it, I made money, I lost money. Real estate, again, is a lot more involved. And, you have expenses that go into it. And also liabilities, too. I tell people, look, if something happens in a property you own with an IRA, if the IRA is the direct titled owner, they sue the IRA if something happens. Now, granted, you should have insurance. You should have the correct insurance in the correct amounts because something like 95% of all these cases settle with insurance. So again, making sure the insurance policy is good is going to be your first big line of defense. But keep in mind that is a concern. And that's why a lot of people, especially in the real estate market,
and the IRA should own the insurance policy, not you, the individual, on the property in question.
And I've seen that it wasn't on anything super major, but I think it was some hail damage for a client's house. They had insured the property incorrectly. They had insured it under a rider on their umbrella policy, personal umbrella policy. And when they tried to make the claim, and thankfully, I think it was like maybe a $10,000 worth of damage, which again is no one's going to not pick up $10,000 on the street, but in the context of a house, not like it burned down and they're out $500,000. But the insurance adjuster said, okay, great, whatever, cool. Well, they pulled up the deed and the IRA was on it. Like, well, this is insured under your personal policy. Like, you can't do that. So again, making sure that the policies are written correctly, the IRA is the named insured on the policy is all definitely best practice. So making sure that all that's done correctly. And to the liability point, there's a lot of options. So investing as like a limited partner in a deal, again, it's going to shield you from liability because you're just a passive investor. The operational organization is the one that assumes the liability for that. Also being on the debt side, lending someone money, holding a first position mortgage in your IRA. A good investor friend of mine who I'd recommend anyone seek out if you're looking for IRAs and more information. He's been investing in IRAs since 1975. This guy named Pete Fortunato had a really good note. He said, well, when someone walks through the house, they don't trip and break their neck over the mortgage. They trip over the floorboard that was never repaired that they sent 15 emails about. So being on the debt side of things, again, check with an attorney, make sure you're following everything correctly. But again, you can be involved in real estate or real estate adjacent without having some of those liability issues and maintenance issues. You have to deal with tenants and termites, toilets with being on the debt side. Again, everyone's preference be what it may. But again, I just like to make sure people understand there's options out there. And if it's too cumbersome to think of an IRA owning real estate with the rules and regulations, maybe become a limited partner in something. Invest in someone's LLC. Lend someone the money. There's a lot of different ways you can play this.
So let's say that you run afoul of those prohibited transaction rules. You swing a hammer or fix the sink yourself. Not something as egregious as keeping a rental in your IRA, living in the rental, and writing off all the expenses, as you put it. What are you looking at in terms of potential penalties should the IRS find out about it? Are they going to disqualify the entire account?
Sure. So the IRS is, not in the business of, nuking someone's retirement plan in general, but they can. So let's kind of start from the beginning, and then we'll lead up to what like the written policy is, because they have a large degree of like flexibility in what they do. So for a smaller infraction, let's say, they found out that you had been doing some small improvements like fixing a water heater, X, Y, and Z. They could have the potential to say, well, this was a improper contribution. They say, you know what, it's under the thresholds. We don't need to tie you to a tree on this thing. We will consider it an improper distribution. So you might have to refile a tax return, pay the penalties associated for the improper contribution. Maybe it was an over contribution, so you have to pay some additional penalties. But I've seen it work out to where, if it's not like an egregious penalty, they just kind of work it out saying, hey, maybe you over contributed or you need to refile some taxes, pay some penalties, you're done. But with that said, the standard, like if you're looking, it's like, it's like you look at like a traffic penalty. It's like reckless driving X amount over. Well, it could be a fine or it could be 3 years in jail. Well, the maximum, what they can do to your IRA, this is wild. So if you commit a prohibited transaction, and let's use the example of something that happened 5 years ago, 7-year testing period, kind of like an audit. Let's say they said back in 2018, you committed a prohibited transaction in your IRA. Well, what they're going to do is to say, well, you're going to have to get everything appraised. We need to know the exact value, and you're going to have to consider the account fully distributable in that year. So you're going to have to distribute the whole thing, taxes, potentially early withdrawal penalties, plus a prohibited transaction distribution penalty, which I believe is 20%. You have to do all of that, kick out those penalties, pay those taxes, refile all of your taxes for those subsequent years. And now and that IRA is no longer in existence. It doesn't blow up all of your retirement accounts. So it's just the one that committed the prohibited transaction. So if you didn't have all your eggs in one basket, it's not kind of like a virus that's going to infect all of them. But again, that is what they could potentially do. And I've seen that happen twice in 12 years. Now, granted, those people were really doing things they shouldn't have been doing. So I'll leave it at that. Now, the penalties are different depending on what type of plan you have. So that is the potential range of what they can do on an IRA. So think Roth IRA, SEP IRA, Simple IRA, HSA, ESA. Those 5 account types, that's what you're looking at. If you do have an ERISA plan, so a 401k, 403b, those kind of plans, it does not blow up the whole plan. It basically is they look at it and say, look, you have to take the value of the prohibited transaction, whatever that was. If it was, you living in the property, it's the value of the property. If it was an improvement of the property or something else like that, well, then it's based on that value. But it's 10% per year of the value of the prohibited transaction until corrected. So not that I would ever recommend anyone to do anything prohibited, because the IRS doesn't have a sense of humor, let's be honest, is to, not commit these things. But if you are in a situation where something does happen, being in a 401k or an ERISA qualified retirement plan is definitely going to be a much more advantageous position than being in an IRA and having to potentially have the whole thing blown up, refiling taxes. best estimate I can come up with is that if you do a prohibited transaction in IRA, it's going to cost you somewhere in the neighborhood of 50 to 70% of your total account value just in taxes and penalties.
Wow. Well, that's I've always wondered how the treatment was handled from the IRS's perspective. One other question I had for you, and we've talked a lot about mandatory distributions from IRAs on the show in the past, is you have a rental property in an IRA. Now let's fast forward and say you're 75 years old and start have to start distributing money out of that IRA. What do you do about that if the majority of the account is an illiquid house that you can't draw cash from, or you don't have enough cash from to distribute? How do you handle that?
Yeah, absolutely. And that's one thing that I always like to make sure people are very well aware of, because it bears repeating and it bears some very careful examination. So again, for people who aren't familiar, at a certain age, you have to take a certain amount of money out of your pre-tax retirement plans. What people don't realize necessarily is that it's not based per account. While, yes, you might have an account at Schwab, an account at Advanta, an account somewhere else, and they say, hey, here's your RMD. That's not really painting the whole picture. You need to take all of your pre-tax retirement plans, add them together, add the values together, plug it into the life expectancy tables, which, if you're single, if you're married, your age, the account values, it's going to spit out a number of what you have to distribute from your IRAs in total to satisfy your RMD. And in years past, the penalty for not doing it was 50%. This year, we got some relief. Thank goodness, because that was wild. So anyways, let's say, for example, you have an account still at Schwab. You just brought over some money to invest in this alternative asset. You still have your traditional at Schwab. You have the traditional at Advanta. Well, at the end of the year, let's say you were invested, because real estate cash flows, right? Let's say you're invested into a long-term commercial real estate venture that doesn't have a lot of cash flow, but is locked up and highly illiquid. And you could extrapolate this to real estate. You have a certain amount of RMD. Well, let's say it's $20,000 is what you calculated as your total RMD. Remember, you don't have to do it from each account. Let's say each one of them calculated out at 10 grand. You don't have 10 grand in that account. You can satisfy the entirety of your RMD by taking $20,000 out of Schwab and not touching the Advanta side of things. And that's, again, more of an ideal scenario. And again, not everyone's in that scenario. Real estate and these things are expensive. So I would say about 65 to 70% of our clients only have IRAs here. So with that said, what's it look like if you're invested in something and you don't have enough cash in the account to satisfy an RMD? Well, that's a little bit tricky, but it's not necessarily something where you're just like, too bad, so sad, there's no options. Here's what in general can happen. If you have cash, extract that. That's going to be the easiest thing. Now, you can distribute assets in kind. You don't have to sell the property. So if it gets to the point where you had an RMD, you don't have to sell the property. But again, there's some things that you have to consider is that, well, how do you do an in-kind distribution? Meaning you take a part of or all of the asset out. So let's say a piece of rental property. Easy enough. You'd have to get an appraisal of the property and a quitclaim deed drafted. And then whatever the portion of that value of that property would be deeded to you personally. So then you would just split up the income according that's coming in and go on your way. Notes are a lot easier because you would just, value the note, say, okay, outstanding principal, if it's interest only, whatever that is, distribute a portion of the note, start collecting stuff on the other side. Things like private equities, private stock, need to get some type of a fixable value and then just assign that out of the account, and then it becomes a personal asset instead of an IRA-owned one. I'm dealing with a client right now that has a lot of private equity in the account, and that's what we've been doing the past few years. He transferred over like 1.5 million, put it all into very highly illiquid projects. And we just do valuations and distribute some of those shares on an annual basis. So he gets no cash out of the account, but he gets a 1099 and an assignment of shares saying, hey, you now own, XYZ biotech and 10 shares are yours now. Here's the value. Here's your 1099 and go on your way. So it's very important, especially for people closer to retirement age that are doing only these types of assets, to be very cognizant of kind of, what that RMD position looks like and the like.
Interesting. So if you have an IRA at Schwab or Fidelity and you buy stocks and bonds, Schwab and Fidelity are making money in a number of different ways. If you have cash in the account, they're taking that and reinvesting it in their bank and paying you just a tiny smidgen and making money off that net interest margin. They're probably selling your trades to other parties in a payment for order flow kind of setup. There's securities lending. There's several other drivers of revenue when you're trading in publicly traded securities through a more ordinary account, whether it be taxable IRA, Roth, solo 401k, whatever. What do you charge your clients, and how's the setup at Advanta?
Yeah, absolutely. And that's another kind of big hurdle that we have because we got to keep the lights on somehow. We don't grow to the point we're at by not making money. And since we don't sell investments, what do we do? So there's a fee schedule with us, and basically we charge for the services rendered. So if you want to buy something, we charge to process that transaction. If you have an asset in the retirement plan, we charge an administrative cost to do that. And that's kind of one of the big things that people think, well, they say, well, I don't have any fees at Schwab or Fidelity. I'm like, well, you do and you don't. Yes, maybe you don't get a bill from them, but they're making money. There's a reason that these are multiples of billions of dollars company. It's not from the altruism of the stockbrokers. They're making money. And again, I can appreciate the fact that you don't see the bill, so you don't think about it. But how does Advanta work? So let's say someone's coming in to do a limited partner deal or invest in an LLC or a loan. Basically, what we charge is $50 to get everything set up and processed over to us. We charge $95 to review investment documentation, all the indicia. It's our purchase of asset fees, $95. And then if you're doing, again, just one single investment, which a lot of our clients do, I think it's something like maybe 35% of our clients have multiple assets in their account because they kind of come in with one project in mind. Since we don't sell investments, they're like, hey, I want to do this, let's plug in. And then we charge $295 per year to administer the account with one asset. So straight in, straight out, you're not paying commissions, you're not paying any type of sliding scale of a point basis. It's just you bought something, we charged you for processing it, you have that thing in your account, we charge you for the administration and the IRS reporting. It's very simple, very straightforward. And especially when you're looking at the sums of money that people are investing in these projects, the actual cost basis ratio is minuscule. When you look at it comparative to, what like a portfolio manager might charge you. Now, granted, our fees only go so low. So if you want to invest like $10,000, the cost ratio is much higher. But again, with self-directed assets, typically the types of assets people are buying are going to be more expensive. Not to say, we have clients that have, $300 accounts that are billed for the value at like $200 a year that love it and do it. And we have people that have a lot of commas in their account too. So take that for what it's worth.
Yeah. Interesting. This has been really informative, Alex. I've always been of the opinion that alternatives in general, and I realize that you don't like to lump real estate into that term, but anything other than public securities, it does have a place in a lot of people's portfolio. I would argue through and through that for 95 maybe percent of Americans, you're going to have a better long-term outcome by investing in tens of thousands of different publicly traded securities through the public markets. But once your portfolio gets to a certain size, alternatives make a whole lot of sense with a portion of it because they are a good diversifier. You can access things that you can't through the public market, so there are some really good opportunities. But it comes back to the analogy of just putting all your eggs in one basket. If you go buy a vacation property through your IRA that you are interested in renting out, that cash flows and gives you a great ROI, a cap rate strong and all that. Well, it's kind of like buying, one stock in your account too. Like you have a lot of concentration risk, and granted, there are LPs and other ways that you can kind of diversify that out. But for our listeners out there, this is a viable thing that makes sense for a lot of people. Personally, my perspective on it is that you really need to have your core portfolio figured out and kind of be the foundation before we explore any of these things. I know you have clients that probably agree with that, and a lot that probably don't disagree that don't agree with that. But personal perspective.
Yeah, and it's maybe not the best thing for someone in at the core of the day, business development and sales. This isn't for everyone. As much as I'd love for it to be for everyone, and we would have 100 million accounts and trillions of assets under administration. There is definitely a benefit, and there's a bandwidth in everyone's life. You have to you have to, make time for everything and understand what your benefit and penchant for being more hands-on with your investing is. And we offer that. We love you get real granular, get in there, be the one driving everything and not be beholden to the stock market. But you also have to be okay with that, giving up that kind of, set it, forget it, automatic rebalance, the workflows, the APIs that people love so much. You have to be able to understand that there is a trade-off to doing this. There's no such thing as a perfect world. You can't, just like, you can't debt finance without tax issues in an IRA, just like you can't live in the property as well. I really agree with you is that, you really need to be objective in anything you do with finance. And that's no different than choosing the asset classes you want to be invested in. If you're someone that's been that's rented an apartment your entire life, you've never owned a piece of real estate, buying a rental property in your IRA is the first step. You might be successful, but it's going to be a big learning curve. If you're someone that is owned property personally and rental properties, doing your entire IRA for rental properties and eschewing the securities market, maybe that's a good fit for you. This stuff is all personal, and it definitely bears repeating. Talk to someone like Grant, talk to someone like me, and we can kind of break that out and say, hey, look, here's what I think your problems might be. Here's where this might work. Here's where it might not. And again, just making sure you have people in your corner that are able to be objective and act in your best interest, I think is a good idea no matter what you're doing.
Yeah, that's a really good point. Go in with both eyes open and, make sure you understand what you don't know, and oftentimes you don't know what you don't know. And that's where, relying on some objective feedback can be really helpful.
Absolutely.
Well, this has been wonderful, Alex. I really appreciate your time. I really enjoyed the conversation, and I learned a ton myself. Where should we direct people that want to know more about this or follow you?
Yeah, absolutely. So Advanta IRA, that's ADVANTA IRA.com. It's our website, a lot of great information. You can catch my podcast on there. We do bi-weekly webinars on all sorts of interesting topics with great guests. All of our education is free. There's no paywall. So I'd encourage people to check that out. I'm on LinkedIn. You can find my podcast, the Alternative Investing Advantage podcast. I know it's a mouthful, but all the podcast names were taken. So, find me on there. Grant was a guest, great guest. We got into a lot of fun stuff about like the range of retirement plans. And again, I learned a lot about, some of the more higher end ones like defined benefits and cash balance. So I'd really encourage you to check out that episode. Great episode. But again, Alex Perny, Perny. You can reach me directly at 727-754-9954. I am on the East Coast. So if you're on the West Coast and I don't answer at 3 in the afternoon, especially on a Friday, I'm doing something more enjoyable with my time. Again, I do really appreciate having me on, Grant. It was a pleasure.
Yeah, this is great. Look forward to doing it again sometime, Alex.
Absolutely. Thanks.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.